Oil is in the red once again today, with crude selling off for the fourth day in a row. This comes as speculation that the Israel-Hamas war could potentially stay contained, with diplomatic efforts going on in the region. We also want to mention the decline that we got in the recent data coming out from the U.S. government, data revealing weekly gains in domestic crude and also gasoline inventories there. So prices further declining on the latest supply readings. Jared Blikre standing by with the latest on the movement that we're seeing within the oil market. Jared.
Hi, Shauna. Let's go straight to the Wi-Fi Interactive, where I have crude oil up, and you can see we got a little bit of a dip. This was on the government report that you were just talking about, where we saw a rise in crude oil inventories. This is a weekly report from the Department of Energy, 1.372 million barrels. Now, that was a surprise because the street was expecting a draw, so a negative 450,000 barrel. When you get the sign wrong, sometimes you do see some movement there, but not a huge deal in the big picture of things. Let me put a year-to-date chart, and you can see here we got this spike to above $90 per barrel, about 95 in there. That was on the beginning of the most recent conflict. That kind of pales in comparison to what we saw last year with Russia invading Ukraine. That did cause a lot more disruptions. Nevertheless, market participants are already looking ahead to the next OPEC Plus meeting. That is going to be happening next week, and expectations are that they're going to hold. So Saudi Arabia and Russia have been holding supplies. They've been actually holding back 1.3 million barrels per day. That's excess capacity that could theoretically come back at any time and help lower prices. But guess what? The Saudis and OPEC Plus, that's their cash cow. So they want to see crude oil at above $100, ideally $110. And when we're talking about that, it's really going to be Brent, because that's the pricing that we use there. A few dollars more, and this is more of a European and Asian grade that Asian importers use. And we can see there a very similar chart, but nevertheless a couple dollars higher there. And just in general, I want to talk about the energy market. Year to date, energy is actually down. It's almost break even, but down ever so slightly, 0.4%. And you can see this is a 2-year chart. Let me put that on a 1 year to date. You can see some vicissitudes in there, but over the last 3 months, we've really seen actually a little bit more of that. Let me put a 6-month chart in there. You can see a little bit more gains. We had one area of trading that would do a trading range to the bottom, and then we have this trading range we've seen since August. And in that time period, let me just put a 3-month show. Energy is the only sector that has been in the green while the general market has rolled over. We saw the markets peak in late July, very end of the month, and then August was down, September was down. October is looking like it might be down as well in the general market. So we'll have to see what comes of this. Finally, I just want to show you what's happening in the energy space. This is over the last 3 months. Let me just throw this into a year-to-date look. You can see for the most part, more green than red. And also got to say that given all the pricing and given all the declines that we've had in stocks in general since last year, and the fact that energy is finally rolling over a bit from those high prices that we saw last year, we're seeing mergers and acquisitions, the latest being Hess, for instance, and that's where a lot of the outlier activity is coming from. We are looking forward to Exxon and Chevron earnings coming up, and so we will be bringing those to you some fine morning when they report.
All right. Yes, indeed. Jared, appreciate it. Thanks so much.